When South Korea's stock market crumbled, investigators looked past corporate earnings, discovering a crisis built on billions of borrowed dollars used to buy shares. This chart tracks the Kospi index, which collapsed 44%, punctuated by a historic 13% single-day drop. This happened because investors used extreme leverage. When prices dipped, brokers issued margin calls. Forced sell-offs by investors lacking cash created massive supply, driving prices lower. A new report from Bloomberg suggests that these same conditions are appearing in India, where record numbers of retail investors are currently trading with borrowed capital. We need to examine if this specific type of hidden debt is signaling a similar crash risk for the Indian stock market. The mechanism driving this trend in India is the Margin Trading Facility, or MTF. This diagram shows how it works. An investor starting with 1 lakh rupees in their account can take a loan from their digital broker to purchase 3 lakh rupees worth of shares, significantly increasing their market exposure. National Stock Exchange data shows the total money borrowed through these facilities reached 1.38 lakh crore rupees. This debt grew 50% in just the last 12 months, as mobile apps made obtaining these loans a single click. The scale of the debt is high, but the risk to the market depends on where that money is being spent. This borrowed capital is largely bypassing stable, large-cap companies like Reliance, HDFC Bank, or Infosys. Instead, high volumes of MTF cash are flowing into smaller, highly volatile stocks. These companies often have low liquidity and are frequently promoted on social media and Telegram groups as the next big opportunity. This creates a divergence in the market. Global institutional funds are currently selling these specific small-cap stocks, while domestic retail investors are using borrowed money to buy them. The market regulator, SEBI, recently introduced stricter rules for options trading to limit the high losses seen in those speculative markets. In response to these tighter rules, many investors moved their capital into the cash market, using margin loans to achieve the high levels of exposure they previously found in options. Systemic risk migrated from one market sector to another, settling into debt that is incredibly hard to exit during a downturn. External factors like rising inflation or a weakening rupee can trigger a standard market correction at any time. In a market fueled by debt, a small drop in price triggers a margin call. Brokers demand immediate cash to cover the difference, and many investors using these apps do not have the liquidity to respond. When the cash isn't provided, broker algorithms are programmed to automatically sell the shares to protect the loan. Because these small-cap stocks have few buyers, this automated selling leads to further price drops, which then triggers a new wave of margin calls for thousands of other traders. In this heavily leveraged environment, a routine dip in the market can quickly turn into a mechanical breakdown of the exchange. There is a significant difference between the crisis in South Korea and the situation in India. Most of the borrowed money in South Korea was invested in global leaders in AI and semiconductors, companies with massive physical infrastructure and global demand. In India, a large portion of the 1.38 lakh crore debt mountain is tied to smaller companies that lack those same global fundamentals. Leverage multiplies your buying power when the market is rising, but that same math means your actual capital is depleted much faster when prices begin to fall. By borrowing to trade on social media hype, retail investors aren't just risking their own savings, they are increasing the vulnerability of the entire financial system.